Good afternoon. Thank you very much. And this is a round that deals with U.S. pension funds investing in Africa. And my name is Rafael Stone. I'm a lawyer and attorney in a law firm in Seattle, Washington, Foster Pepper. And also on our panel here are Cheryl Austin, who's executive director of Dallas Retirement System, Nick Ferdsley, who is president of the World Pension Council, Joseph Boiting, who's CIO of the Casey Family Programs, John Espinoza, managing director, TIAA Craft, and Kim Liu, vice president, co-chief investment officer, Carnegie Corporation of New York. A little bit of background about myself. I chair what is called an investment management group in our law firm. We represent approximately 32 public U.S. funds, probably the largest collection in the U.S., 6 of which are the largest funds in the U.S. We probably runs to approximately a couple trillion U.S. dollars. We primarily do their alternative investments, which includes private equity hedge, infrastructure, real estate that's globally invested. That being said, I agree with an earlier speaker who said that the percentage of U.S. funds invested in Africa is very small compared to the capital we have to invest. And it's unfortunate that they did not film our session a few minutes ago in the conference room, which was very robust, about why U.S. funds aren't investing more in Africa, and hopefully it will be a robust panel here. That being said, I do believe that there is significant interest by U.S. funds in Africa, investing in Africa. In May, I was a panelist with 10 large U.S. funds who were going through the ABCs of Africa, and it's hard to believe that as sophisticated as you think they are, that they wanted to go through the ABCs of what Africa countries there were, how many there were, what made up those companies, what their strengths were, et cetera. That being said, there was a couple $1 trillion of managers there, the CIOs, so obviously there's an interest. And this last year, I think we've invested $120 million in commingled funds in Africa. So there is interest. A couple years back, I could not have said that. I know we're running short on time, so I'd like to throw it out to the audience for any questions you may have of this panel, which is really an outstanding panel. So any questions?
Just one question, maybe for Nick or anyone who can answer it. You talked about the ladder of investments and the infrastructure, so direct infrastructure play being somewhat at the bottom. Does anyone have any examples of where you've gone down to that level and been successful of direct plays in infrastructure?
We don't invest, we're like an association of asset owners. But I can tell you what I'm seeing from some of our members. It's really early stages. So there's more talk. There's much more talk of pension fund and sovereign fund investment in sub-Saharan African infrastructure than real deals being made. It's really embryonic. And what I would say is the following is only the very large public pension fund can afford to do it because it's highly illiquid and it's difficult and it's complicated. It is interesting, of course, and it's potentially very much rewarding because if you look at an infrastructure asset, an ideal infrastructure asset, so let's take a highway, a toll road, or some rail tracks, or some utility companies. On the one hand, it looks very much like a bond because it's generating every week, every month, every quarter, some kind of yield, which is similar to what owning a fixed income instrument would give you. Yet at the same time, in theory, risk-adjusted returns, even taking into account the relatively high risk, the country risk that you have in Africa, they're interesting returns. So there's a compelling case, you can show it using an Excel spreadsheet, etc. Compelling case in favor of more investment in emerging market or even frontier market infrastructure. In reality, it's more complicated because even if you look at infrastructure in the US or the UK, which are mature, sophisticated, low-risk countries, we don't see as much infrastructure investment by pension funds as we should. And if you look at Canadian and American pension funds, where is the bulk of their infrastructure money invested? Well, it's a lot in the UK. So they prefer buying rail tracks and utility companies in London than doing so in Indiana or Ontario. So a lot of that money is going to London. A lot of money is going to Australia. And so one of the reasons why a lot of infrastructure investment by pension funds is not going to emerging market or frontier market, but going to Australia and the UK is that the rule of law, you know, fiscal efficiency, the fact that if you're unhappy with your partner, and if the partner happens to be a municipality or the Ministry of Public Works, you can take him or her to court and have a quick resolution of the case. That, of course, is very difficult in most jurisdictions, all the more in Africa. So one of the reasons why people like the UK and Australia is they view the court system as being very quick and efficient, and they view the court system as really being fair to the outsider, even more so than the court system, let's say, in New York City or Montreal, right? So to conclude and answer your question, I think the easiest, the logical path for more public pension fund investment into sub-Saharan frontier markets would be co-investment jointly with supranational institutions such as, you know, the World Bank, the European Commission, the Chinese government. So all these, you know, the recently founded, you know, AIIB, the Asian Infrastructure Investment Bank, which was incorporated in Beijing, I think 7 weeks ago. They have amongst their founding fathers and founding mothers many African governments, and they have said that in 2016, 2017, they will put money on the ground, not drones, but on the ground in Africa. And the Chinese have announced that they would love to co-invest jointly with American and Canadian and British pension funds. So all the stars are aligned. It will take time. It will take time. And I think Hubert here himself, one of the many hats he wears, I think is advising the Mauritius government, right, on that issue. So you're seeing things happening everywhere, including in Mauritius, Madagascar. People are starting to do their homework. It will take time.
We have another question here.
Thank you very much. I'm about to go to a meeting which is Investment Committee of an institution that I am on the board of, and I'm looking at their report, and I think Cambridge Associates, they talk about the first half of the year, first part of the year, returns, and every sector of the market is down, with the exception of Japan. So I'd like to ask you, what is your outlook for emerging markets in general over the next 18 months? Because we have very smart money around the table. And what's the outlook for Africa returns?
Well, we were discussing that in the conference. Who wants to take that on?
I'll answer it. We tend to look at a very long term. 18 months is way too short. Otherwise, I'll be trading or keeping it in cash. So if you're looking at, you know, some of these classes like investing in private equity, emerging markets, you know, you have the headwinds, the dollar, confidence, slowing down in, you know, global, call it trade, or you talk about the commodities meltdown, is the super cycle busted? I think 18 months is way too short, and that's part of the problem that we face, trying to even come out with predictions for the next, call it 3 months, or the quarter by quarter. Sometimes it becomes an obsession. It doesn't help the committee, neither does it help the investment staff. And the twist to it is that you have, you know, consultants coming up also with long-term capital markets returns, 7 to 10 years, you know, out, and they are revising it every 3 months. Again, that doesn't help anyone either. So that is my 2 cents on that.
And
good question. Go ahead.
So I think that's actually a very good question. If I can just take a step back and I'll get to your question about roadshows, but I think it's also important to put into context that within Africa, just 5 or 10 years ago, I remember that emerging markets itself was not a core asset class for either public pension funds or just asset managers. It was very tactical and opportunistic. And now you look at any kind of product shelf out there for asset managers, and they will have both a debt strategy as well as equity strategy in emerging markets. So I think that putting that into context, I think going forward, it's an evolution. I focused on Asia for many years and see many of the challenges as well as opportunities in Africa now. So going forward, I think it's quite possible that we could see it become more of a core, region for cross-asset investments, not just what I'm involved in, but across the board. But to answer your question about roadshows, because not only do I, but all the other folks on my team, whether it's on the research side or portfolio management side, go to these roadshows. And whether it's sovereign issuers or corporate issuers or bank issuers, we have a lot of that visibility, with teams that come from Africa. And definitely it's, I think, I don't have a kind of consistent evaluation. I think they're all kind of across the spectrum. You have the South Africas, of the world, where you have their treasury team. They come, they're very experienced, they're very sophisticated. They've been doing this for a long time. But keep in mind that a third of their local bond market is held by foreigners. They have a free-floating, exchange rate. Convertibility is not an issue, so they're very used to this. And their corporates and banks also. And then on the opposite side of the spectrum, you have some recent issuers in the sovereign bond market, like in Ethiopia, which has traditionally been a very closed economy and not very open capital markets. And what we see is, in terms of that evolution, is you start out typically with a sovereign bond issue. You get your policymakers and your team trained, by bankers, being able to anticipate questions from investors like ourselves, making sure that you get a rating from the rating agencies, so that your debt is more easily understood, and there's research broadly available, and we think those are kind of the building blocks to eventually get from some maiden issuers in the sovereign debt market to where the South Africas are of this world.
I think one of the things I would add specifically is one of the things I see is that there are big differences between LPs. LPs are looking for different things. Some people are really driven by return. Some people are really driven by asset allocation. Some people feel their expertise is in manager selection, while others feel it's in asset allocation, right? So knowing what there's a shoe for every foot, but not every shoe fits every foot, right? And so you hear oftentimes people come and they'll pitch a story about, this is my Africa story. And that may be true, but that's not what I'm looking to buy, right? But there is LPs out there who are looking just for that. And so I think there's a lot of investors who waste a lot of their time and their resources. It takes a lot of energy, I know, raising capital. And it's time you're spending when you could be investing. And so the upfront work you do to make sure that the thing you're selling is the thing that the LP is willing to buy is time well spent. And you may be offering things that are right for more than one different LP, but make sure the story you're telling is the right one. Because some people really feel strongly about diversification. They're investing because they feel like this is going to offer them opportunities when other parts of their portfolio are not, especially in this world where we're increasingly hearing that there's convergence and there's not a lot of diversification domestically, and so people are looking outside for that. That's a story some people want to buy. Some people are absolutely looking at the growth story of Africa, and they want to hear that. But the type of return they're looking for is high because they're buying a growth story. So know what they're buying, make sure you can deliver that, and don't waste your time with people who are not trying to buy what you're selling, because it's really not a good use of your time.
one thing I would add on the public side, public venture funds is just like you said, the variety of funds out there is just tremendous. And so understanding in terms of who you're talking to and what they need as a pension fund is really critical, and who they rely upon. You mentioned gatekeepers. And some funds, if you're talking to big funds, they're going to all have gatekeepers. And their job is to say no, unless you can show us why. And so in terms of meeting with them, you've got to really come prepared. You've got to have a team, and you've got to have a history of this team, even though you're an emerging market from an emerging country. You know, still you've got to show that we've been together so many years. We've got so much experience because, you know, we're really looking at that person across. You talk about that team that we're really looking at, because that's where we're putting our money. And then there are some funds who the CIO is going to be making the call and not the gatekeeper. So to a certain degree, you've got to do your homework and know who you're presenting to, and then how to get into that, if you will, the right person or the right group that's going to make that decision. But in almost all cases, you've got to show that the team out there that you're putting our dollars with is a solid team in the sense of some type of years together. They've worked together. It's not 5 people who've just come together last month and said, we have an idea. And so you have to show you've done your homework and show you've got a package and be able to present that in a very logical, business-like manner. And I don't know if I'm answering your question, but a lot of what I'm saying I think is common sense. That's how, from our client's perspective, because in many cases we assist on the due diligence. That's how you have to go about doing it. I think we're there on our time. We really, maybe not real. Can we have one more quick question?
Just a follow-up. Thank you for that. Question is, we have on one hand incredible interest in Africa. You have U.S., certainly money around the table here, willing and interested in coming. You also have U.S. businesses that are looking for business. So what I don't see here is a synergy between the two of you, because you talk about the team, somebody talk about capacity building. So, for instance, Côte d'Ivoire will be releasing about $66 billion worth of planning for the next 5 years. And we always meet with US companies. They come along. What if you can all talk together here, bring the expertise with the financing, and then ask government, what are the securities that you provide for our investment to be safe? Because we know the partners that we're dealing with. I mean, I don't see that synergy. What are you doing about that?
You raise a very important point, i.e. the investors, the financial investors or the pension funds and endowments, their goals might be different from the strategics, the company. If I'm operating company deciding to go into Côte d'Ivoire, Ghana, Nigeria, my considerations might be different from the institutional investor that is coming in for all kinds of reasons. It could be ESG, it could be the returns, it could be I don't know, they could have other reasons. So getting the synergy here among the investors before coming is a very hard one, because our goals are very different. Even on the institution side, very different. So it's a matter of how these opportunities are pitched, or how the roadshows are targeted towards the ultimate investor, be it the strategic or be it the institutional investor. Because in most cases, there's also a cultural thing which has to do with it. I've talked to people on the ground, and to the extent that you're used to receiving aid and you meet with someone, you have private capital to deploy. Meanwhile, they're talking about CDC, DEG, FMO, and it's like, great, good to have that. But this is private money that needs to make money. Different set of considerations from maybe an UPS making a direct investment, over there. But I hear you on the other side, it could be very confusing on your side. So our approach is to be on the ground, talk to the people, explain how we're different, how we evaluate these opportunities, and be ready to play if it makes sense to us. Because just being passionate, sometimes you meet folks, they're extremely passionate about the opportunity, but it may not address our needs. It doesn't go anywhere.
That's
So-
a very good question, and I know this doesn't help you, but in terms of alignment of interest, there is very little. And we do invest for different reasons. And so you just have to understand it, and it is confusing, but there's very little alignment of interest among LPs. They're there for different reasons.
And
Interesting
I
like
would
that.
I would just add in the way that, look, Africa is not it's not monolithic. The way we approach investing in Africa is very differentiated. Well, everyone sitting here, we're not a monolith either. We have, different mandates. We're charged to generate, sustainable, consistent investment outperformance for our participants, given our structures and our, requirements. What I would do is actually kick it to the countries and the fund and capital seekers, for them to provide, the proper, environment to attract, investors like ours. Again, I go back to Asia, where public-private partnership was, just a catch-all, term, a few years back, and it was used from places like Indonesia or India or the Philippines that really have massive infrastructure deficits. Yet, if you look at the capital realization, even putting together very strong PPP type of frameworks in place, it's actually underperformed. And I say this more as a cautionary tale towards Africa, that Africa has to, and the countries themselves and governments and policies have to set up the right policy, the right environment to attract, investors like ourselves that have very different focus and mandates.
And just a very quick point is, I would say that if you look at big corporates from the US, and as opposed to pension funds going to Cote d'Ivoire or Rwanda, I would say their interests in the short, medium term might be extremely divergent, because if you're a Colgate-Palmolive or Volkswagen, and if you want to go into Cote d'Ivoire or Rwanda, the calculation you make might be a 30, 40 years calculation, and you may want initially simply to grab market share, and you may be willing for 5, 6 years to lose money. A pension fund or an endowment cannot afford to lose money in Cote d'Ivoire for 5, 6 years. I think that's a big difference.
But I'm patient.
Yeah, thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.